Well, welcome to the Three Corners Capital third quarter investment webinar. For those that might be joining for the first time, thank you. We hope that you find the investment of your time worthwhile. I'm Chris Flores, and along with my partner, Steve Fortin, we own and manage Three Corners Capital. And each quarter, we host this webinar to bring timely market updates and insights from the investment firms we hire to manage various aspects of client portfolios. We offer this direct access to investment firms as a unique opportunity to add value to clients, and with a primary motive to help clients learn about the markets and also cut through noise and news that can oftentimes inundate us and feel confused. To keep this call short, as always, we don't do live questions and answers. However, if you do have any questions about this call or anything else, please do not hesitate to reach out to us. Today, we're excited to have Jack Orwig with Lord Abbett present. And at Lord Abbett, Jack serves as an advisor to advisors and is a tremendous resource for our firm. Before he goes into his presentation, I did just want to use our call as a timely opportunity to share a couple of slides that I thought were relevant, just given the market volatility that ended July and started August. And the first thing that I wanted to share is rooted in this idea of our behavioral biases. And one of them is action bias, this desire that we have as humans to want to take action on something. And this chart shows the risk of missing just a few of the best days in the market by selling out. And you can look at this chart and see that an investment of $10,000 starting in 1979 through the end of June of 2024. If you remained invested, you're in the far left vertical column. And then for missing the best 5 days, missing the best 10 days, missing the best 30 days, and so on, you start to lose out on market participation. And the reality is that in many cases, the best days occur very shortly after the worst days. So again, we want to take action, but in a lot of cases, that action can cause more harm than good. But that also leads us into another behavioral bias, which is called anchoring, where our judgment is influenced by a reference point. And for many investors, that could be the dot-com bubble, the financial crisis, where we see these high watermarks or these high values, these all-time highs, followed by a really big pullback in the markets in a recession. And so when we see the news about hitting new all-time highs and things like that, it causes us some angst or anxiety around investing. We say, well, it's now the right time. And what this chart, especially on the right-hand side does is look at cumulative returns over multiple periods of time, investing on any day in the market, using the S&P 500 as the reference point, versus just investing at all of the all-time highs. And what you can see is it really doesn't matter that in any really rolling period, the whole point is to be invested. And so just a friendly reminder that a lot of times our own attitudes and behaviors can get in the way to ultimately leading to us to investment successes. And so with that, I'm going to turn the call over to Jack, and he'll lead us through his and Lord Abbott's thoughts on the markets with a specific focus on cash and bonds in particular.
Wonderful. Thank you. Thank you, Chris. Just to make sure you can hear me okay.
Yes, you're great.
Wonderful. Wonderful. Thank you. Yeah, thank you to Chris. Thank you to Steve. Thank you to Three Corners Capital for having me on today. As Chris mentioned, my name is Jack Orwig, and I represent Lord Abbett. I just want to give a quick introduction to my firm, Lord Abbett. We are an asset management firm based in Jersey City, New Jersey. We're an independent, privately held firm, so we're not publicly traded. The firm has been around since 1929. Pretty neat fact, making us one of the oldest money management firms in the entire world. We are an active manager with the goal to outperform the market and indexes over time. So that's just a quick intro to my firm, Lord Abbett. My goal is to share today just some thoughts from Lord Abbett on the current interest rate environment, which Chris and I thought were timely topic to cover. How that translates to potential opportunities in the market, to take advantage of. So, what does it mean for cash? What does it mean for CDs? What does it mean for money markets, etc.? Before I jump into it, let's quickly talk about the economy. Here I'll quickly focus on not what we think, but what we know as it pertains to the economy. So we know inflation has come down from decade level highs. That's number one. In the most recent reading, inflation fell below 3% for the first time since 2021. So that's great news. We also know that after the Fed has raised rates at a historically fast pace, the economy is still strong. Slowing down, yes, but unemployment remains well below the 10-year average. Unemployment at around 4.3 versus an average of around 5.7. We know wages are growing a little faster than inflation. Household debt to net worth is very strong. Retail sales surged in July. We just got that data across our desk here. The consumer is still consuming. 70% of our economy is the consumer. And we also have, and I'll touch on this later, $23 trillion sitting in cash. So finally, we know corporate profits. If you just look at corporations, corporate profits are accelerating and beating estimates. Earnings grew around 11% for the second quarter. That's the best since fourth quarter of 2021. So corporate profits are still strong / resilient. And corporate earnings have a very high correlation to the stock market. So historically, when you see good corporate earnings, stocks tend to do well. So if we switch gears a little bit to the Fed, what do we know about the Fed? The Federal Reserve, led by Jerome Powell, has been clear, right, about its intention to cut rates this year. How many rate cuts should we expect? We don't know, right? There's been a roller coaster ride of expectations this year. All we know is that the Fed is expecting to cut rates this year. If you rewind to January 1st of 2024, just to kind of underscore how volatile expectations have been for rate cuts, January 1st of 2024, the market expected 6 to 7 Federal Reserve Fed funds rate cuts this year. That was January 1st. By mid-year of 2024, just a few months ago, expectations went from 6 to 7 down to about 1 or 2 Fed cuts. And now fast forward to today, the market expects, looking at Fed funds futures, about 3 to 4 cuts before the end of the year is expected by the market. And it's worth noting, expectations can change very, very quickly, as highlighted, with the volatile ride we've seen year to date on expectations. What we do know is rates fall well ahead of the first rate cut historically. And that's the big point here is, although we don't know when or how many cuts are going to come from the Fed, what we do know, using history as a guide, is that rates fall well ahead of the first rate cut historically. Think about the 10-year Treasury yield. That falls well in advance, 6 months on average, prior to the first cut. So history tells us that. What does that mean? If you're waiting to deploy cash until the first cut, or you're waiting for yields to drop significantly in your money market or CD, you may miss out on some nice opportunity for some potential gains if yields start to fall, as history would tell you they will. One way to think about it is, if you are an owner of a bond or a bond fund, when rates go down, you have an asset that appreciates in value. If you own a money market or CD when rates fall, you really have nothing to show for that other than your updated yield, which is most likely lower in a falling interest rate environment. So I'll say that again. If you're an owner of a bond or a bond fund, when rates go down, you have an asset that appreciates in value. If you own a money market or a CD when rates fall, you have nothing really to show for it other than your new lower yield. So what if rates, do not go down from here is a question we always get. Even if rates don't fall right away, or the Fed does not cut rates this year, you have a huge yield relative to where the bond market has been just a few years ago. So we also know, looking at the market, that despite all these great yields that investors can invest in the bond market, there's still a mountain of cash on the sidelines. This brings me to my first slide that I'm going to share, and I'll do that quickly here. So just bear with me. Okay, you should be able to see my screen here, which is a slide that says, has cash become a replacement for fixed income allocation? So as you can see on this chart, just about $23 trillion, trillion with a T, if you can believe that, is sitting on the sidelines in cash, deposits, and short-term assets. Just about $23 trillion. Money markets in the green make up about 6 trillion of that close to 23 trillion. So 6 trillion, give or take, is sitting in money market funds, and 22 trillion in cash-like vehicles. If we add it all up and put it into perspective, we're looking at an amount that is just about half the size of the overall stock market. So again, $23 trillion is about half the size of the overall stock market, to put that into perspective of how much cash is on the sidelines. We are finally starting to see some of this cash move to take advantage of yields, because yields are at decade level highs in certain areas of the bond market, both taxable bonds and tax-free municipal bonds. And based on everything we know that I just laid out, there are many areas of opportunities in the bond market. We like the historically attractiveness of yields today, both in taxable and tax-free municipal bonds. And the eventual Fed rate cut is just icing on the cake for potential appreciation, which I'll touch on here in a minute. So let's go to the next slide. Of course, here are some disclosures, and I will go to our next slide here. With the looming cut by the Federal Reserve expected, the market expects the first cut coming in September. As I just mentioned, expectations can be all over the map, so use that with a grain of salt, or take that with a grain of salt. But the market is expecting right now, looking at the Fed funds futures market, that the Fed will cut rates for the first time in September. So I wanted to share this chart because we think it's very timely. Dating back to the early 80s. So this data goes back a long time. What we're looking at here is how different asset classes perform after the first Fed cut historically. And if we get that in September, that's right around the corner. So we're looking at different asset classes. First is the Barclays Aggregate Bond Index in green. You can use that as kind of the proxy for the overall bond market. That's the green bar. The S&P 500, which we all know, widely used S&P 500 to represent stocks, in blue. Short-term bonds in gold. Municipal bonds, tax-free municipal bonds in purple. High-yield bonds in light blue. And then T-bills representing money markets in gray. Or I should say, similar to money markets. So that's the T-bill, 3-month T-bill in gray. As you can see, the green bar, the Barclays, or I should say now the Bloomberg US Aggregate Index, wins and outperforms 1 month, where you actually tie high yield bonds over 1 month. But come 3 months, 6 months, and 12 months, or 1 year after the first Fed cut, the Barclays, or the Bloomberg, bond ag outperforms even the S&P 500. And it does it with about a quarter of the volatility of the S&P 500. Not far behind are short-term bonds and gold over 12 months, and then municipal bonds in purple. So again, a lot of opportunities in fixed income, especially if history is a guide. After the first Fed cut, these different areas of the bond market tend to be very, very attractive to invest in. We get the question a lot, how can that be? How do bonds outperform stocks when the Fed is cutting rates? First, I'll say again, this is just using history as a guide. We are not certain how it'll play out moving forward, but when yields fall, your bond and bond funds appreciate in value, giving you your yield and price appreciation, which I mentioned earlier. So if we do see yields falling, that's what you can expect is your yield and some potential price appreciation on top. Another and final example of this that I wanted to share is this third chart. Again, here are some disclosures for the first chart or the second chart that we looked at. And then finally, here is the final chart that I think is very timely as well. This chart, again, looking back over the same time frame or very similar time frame as the last chart, going back to the 80s. But we're looking at here are examples of high CD rates. So I'll read the first three bullet points because I think this flyer says it better than I can. And then I'll give you one example that we think is similar, not the same, but similar to a time period that we're living in today. So the first three bullet points of this slide, yields on CDs tend to look the most attractive after the Federal Reserve has been through a cycle of raising short-term rates. So we've just been through a cycle of the Fed raising short-term rates. The second bullet point, in the 12 months following the previous 7 periods, when CD rates look the most attractive, short and intermediate term bonds outperform CDs by a wide margin. And then finally, historically, these periods have been followed by a cycle of the Fed cutting short-term rates. And again, the market anticipates, not Lord Abbett, but the market anticipates the Fed cutting rates for the first time in September. And CD investors are forced to reinvest at lower rates. So that's the gist of this research. I like to point out example number 4. I know it's a little small here, so I'll explain it, or I'll kind of read off what example number 4 is. But it's March of 1995 when CD rates peaked, and the peak CD rate at that time was 5.7. Similar to where we were at peak CD rate this time around. I'm not certain what the peak CD rate was, but I believe it was close enough to 5.7 to use this as a nice example. 12 months later, the 5.7, if you were to renew that CD, your new CD rate would be 4.6. That was the CD rate 12 months following the 5.7. So again, 5.7 was your peak CD rate. 12 months later, you were at 4.6. And as you see with the red number, that's a drop in a CD rate of 1.1. So maybe not the biggest drop in your opinion. Maybe you'd be happy with a 4.6 CD rate, and that's great. But the point of this flyer is, or this research is, when you experience that 1% drop, that tends to be very good for bond or bond funds. So how that played out in 1995, you bought your 5.7 CD, but if you were to invest a portion of that money into a short-term bond fund, you would have been up 9.4% over that same time period. An intermediate term bond, which is a little longer, which gives you even more price appreciation. The longer you go out, the more price appreciation you could get. At the same time, depreciation if interest rates went up. So you want to think about that as well. But in a declining interest rate environment, in 1995, you were up 12.9%. So on average, if you tally up all of these different years where we've seen similar environments as far as peak CD rates go, the excess return in a short-term bond fund was 3.65. The excess return in a short-term bond fund was 3.65. And the excess return in an intermediate term bond fund was 6.26 excess return. And short-term bonds and intermediate term bonds outperform CDs 100% of the time in these examples. So hopefully that's not too much. I really like those three slides. I think it puts a lot of things into perspective. The pile of cash on the sideline, we're starting to see some of that move into opportunities in the bond market. When the Fed starts cutting rates, it tends to be, using history as a guide, a good time to be thinking about these type of investments. From a CD perspective, it tends to be a nice time to think about diversifying into a short-term bond fund or an intermediate-term bond fund. Again, using history as a guide, I would encourage everyone to talk to your financial advisor, Steve or Chris, to see if this could be a good fit for your risk tolerance. But again, thank you so much for your time. That's all I had, Chris and Steve. So I'll stop sharing my screen. Just in summary, there are historically attractive yields in bond funds right now across the board. The market is expecting Fed cuts in 2024. This may be a good time to have that conversation with your financial advisor. So I'll stop there.
Okay, thank you very much, Jack. That was great. We really appreciate you sharing your thoughts and insights on the current markets, interest rates, the Fed, and how to position cash in the short-term portion of your portfolios in this environment. One other thing that I'll add about CDs, and we're not here to poo-poo CDs, but it's important to also think about the liquidity or the lack of liquidity with many CDs. And so thank you to all of our clients and guests attending today. Our goal was to bring timely information and insights to you from experts in the industry. And so I feel we scored well today. Thank you, Jack. But if you have any questions about today's presentation or would like to discuss your personal portfolio, as always, please feel free to reach out via email, phone, or text. And so thanks again, everyone, and have a great day.